Joining me is RSM Chief Economist Joe Brusuelas in studio. Joe, it's great to have you, especially on a busy data day like this morning.
Good morning.
All right, let's start with the retail sales in September. Better than expected. August unrevised. What's your takeaway?
So we've got an American consumer that's in an incredibly good place right now. Consumption's absolutely rock solid. So you mentioned 0.4 and 0.7 on the control group, right? Now, if you take that out to a 3-month average annualized pace, it's up 6.4%. But wait, it gets better because inflation has been falling. You have to go in and inflation adjust those numbers. It's much stronger. It's 0.5% on the top line. When I go ahead and adjust for inflation, that's 5.2%. That 3-month average annualized pace, especially for the control group, right? 7.5%. So what that means is, as we head into this absolutely critical holiday spending season, the consumer now is sitting where the unemployment rate's at 4%. Wages have been moving higher. It's above inflation for the past 18 months. So we're ready to, I think, to accelerate. You know, I saw the National Retail Federation said they expect U.S. consumer to almost spend $1 trillion this holiday season, $1 trillion. So that the doom and gloom crew out there that keeps saying it's the end of the world, I got to tell you, Kristen, it's not. We're doing very well as we pivot towards a strong close to 2024.
And we've seen some solid growth, obviously, in the third quarter, 3%. It sounds like, Joe, based on your models, that we'll see continued growth here into the end of the year. For those people who would say, oh, it is doom and gloom, consumer debt is extremely high as interest rates are still elevated, how would you respond to them in terms of numbers that would support that the consumer really is strong, even beyond today's figures?
Consumer debt's high compared to what? As a percentage of what? It's not. We're just getting back to 2019 levels. The consumers, because of the great financial crisis, along with the corporate sector, engage in a 7-year period of deleveraging. That's simply not a problem right now. There's plenty of liquidity out there. The unemployment rate is 4%. We're at full employment, right? And so when you take a look at that, well, there's two sides to every trade, right? Somebody's got to be on one, somebody's on the other. So somebody's out there thinking, well, we're overextended. I got to tell you, I just don't see it. The fundamental strength of the American consumer comes from that labor market. That labor market is strong. We're still short people in this economy, I'm telling you. It's one of these things that's going to be a period of adjustment to lots of people who understood what the economy looked like prior to the pandemic. Within 5 years, we're going to be short 6 million workers in my estimation. This is just tight labor market. Wages going up is just going to be part of the American economic narrative for the foreseeable future.
Joe, you joined me 2 weeks ago, and since then we've seen devastating storms really take hold across the southern part of the country and up the East Coast as well. Hurricane Milton being the latest one that we've covered on the show, and of course the aftermath of that. How do you expect that to impact the economy and show up in some of the data?
Okay, so you're going to see a modest impact on GDP. You mentioned GDP in the third quarter. Atlanta Fed's going to update their GDP Now model in probably just about 60 minutes. It's probably going to be closer to 3.4% for the third quarter. But you'll see a modest drag in the fourth quarter. Remember, we're talking about economic activity here. So what it takes away in the first part of the fourth quarter, it'll give back either December 2024 or it'll spill over into the first quarter of next year. So I'm not really that concerned. Where you will see the distortions, though, you saw it in this morning's jobless claims, right? Now, it came in at 241, which was better than the 259 I think everybody expected, but it's still above the 231,000. That was a 13-week moving average, which is our benchmark that we look at just prior to Hurricanes Helene and Milton. You're going to continue to see distorted data for the next number of weeks. Okay, now here's the big thing. When we all reconvene on Friday, November 1st for that October jobs report, it's highly likely that the 33,000 workers who went on strike at Boeing will show up as not on the job in the BLS employment report. We think at least 100 to 150,000 will show up as not working due to both Helene and Milton. Therefore, we're likely either to have a flat or a big fat negative number on that first Friday of November. Now, normally we really wouldn't talk so much about this, but let's be honest, the following Tuesday is the national election. So people are really going to jump on that number. And what we're talking to our clients about is, hey, this is just a weather-induced deviation from the trend. It's noise, not signal. It's going to take a couple of months for this to work out. My sense is you'll start to see them come back to work in the November and then the December, but we really won't get a clean labor report until January 2024 or February 2024.
Interesting. So the big question then, Joe, is how does that impact the Fed's next decision just 2 days after the presidential election on where it goes with rates?
Yeah, now the Fed moved that to Thursday to stay out of the noise around the election. I think the Fed is well positioned to cut rates by 25 basis points on November 7th, and then to do it again on December 18th. But I think 50 basis points right now really is off the table. While I really feel for people in the Southeast, right? We had family that were affected by this.
I'm sorry to hear that.
Right, I mean, it was a real difficult 24 hours trying to track people down, both, in my household and then our employees at work. It's not going to cause enough of a dislocation in the American economy anywhere near, say, what Hurricane Katrina did in 2005. The Fed will just look past the volatility like it does when we get price spikes in oil markets. They know that it goes up, it comes back down. Mm-hmm. And economists, we love to talk about broken window fallacy. Just because a window gets broken and it needs to be replaced does not mean that's growth. That's a loss of sunk cost. Somebody has to pay for that, right? So it's just more vol in terms of overall economic activity. Mm-hmm. But I want to just reiterate, those job numbers, they will be distorted for some time.
Yeah. And do you think that message is out there in the markets that investors, people following what happens down here on the trading floor and of course watching our show, are prepared for that?
Okay, so our viewers who are watching NYSE TV, they know this. The public, however, people who run small and sometimes medium-sized businesses, they don't know. They're not informed about this. So you're going to begin to hear this. It won't just be economists like myself, it'll be my colleagues over at Goldman Sachs and at Citi and JP Morgan and Morgan Stanley that will begin talking about this in earnest next week. And you'll begin to hear this more. And what's important is that we don't overinterpret what's going to be likely a negative number on that report on that first Friday of the month. Again, that will be noise, not signal.
Interesting. And Joe, we are awaiting remarks in the boardroom, so we can continue our conversation here. It's so good to get your insight as always, especially as we navigate the stock market together, but we will need to eventually get to the boardroom. I'm just curious in terms of crystallizing what this jobs report will mean. You think the bulk of the distortion will come from the Boeing strike?
The Boeing strike and Hurricanes Helene and Milton that are going to be causing a deviation from the underlying trend on the top line.
Okay, good. So we know that the boardroom remarks are underway. We'll be tossing to that shortly here. I'm just curious, Joe, in terms of what else is on your radar. We've talked about the recent impacts, jobless claims, and you'll be able to join me after the opening bell as well to talk more about what this means for business investment. I'd love to get your take as an economist as to how businesses should be operating and planning in this environment.
No problem. We can definitely talk about that on the other side. You know what I'm looking at right now this morning, because we're about to get the policy decision from the European Central Bank. Well, the American economy is booming. In Europe, it's stagnating. Right now, I see a European economy that's just not good. I see a Canadian economy that's sluggish and a UK economy that needs a boost. We're going to get that rate cut.
Joe, great to have you rejoin me here, and we see stocks opening up strong on the back of this data. We also got a key rate decision earlier today from the European Central Bank. What does that mean?
So what it means is that the U.S. economy is moving along at a very good pace right now. Before the data, we had growth tracking at 3% in our own model. The Atlanta Fed was at 3.3%. So I think what you're going to see here is a really nice tailwind into the final quarter of the year. And we can already see the banking sector's first look at corporate earnings looks pretty robust. Now over in Europe, it's a very different matter. The economy is stagnating. The German economy is really in trouble here. So the European Central Bank, in my estimation, really has to hit the accelerator on cutting rates. The ECB is falling behind the curve on the Fed, and they're the ones that really need the help. As a matter of fact, I think that the ultimate policy destination in Euroland will be below where the terminal rate of the Fed is. Therefore, that strong dollar, risk off when it comes to the euro, right? There's a real trading direction here, I think, setting up for the next couple of years. But that just gives you a good sense of where the two most important economies in the world are right now.
Interesting, and I want to get your take too on how businesses should be navigating this environment. We talked a bit about that before the opening bell, but with stock prices right near record highs, strong gains today, globally, the landscape that you laid out there, how should businesses be planning and moving ahead?
So you know what, we can look at those job numbers, those retail numbers, and think, okay, so in the third quarter of the year, average hours worked was flat. Yet we added 140,000 jobs a month, and it looks like we're going to be growing somewhere between 3.2 and 3.5% in the current quarter. You know what that means? Margins are widening, profit margins are improved, revenues, net earnings, all improving. So this is really important. It means that prosperity is beginning to broaden out, not just amongst the American household, who clearly is spending money that they have, but also you're going to see those public firms really begin to see improved valuations on their equity shares. It's just not going to be the Magnificent Seven. You know, one of the real hurdles, I think, was overcoming that wall of worry of an overconcentration on valuations in equity markets. Looks to me like it's going to be spreading out here as we go forward. You know why? We're mid-cycle in economic expansion. This is what you want to see. This is what you should see.
Yeah, good. Okay, Joe, always good to get your take. We'll be waiting for those Atlanta Fed revisions for GDP growth later today. And we'll be checking in with you, of course, throughout the course of the next few weeks heading into year end. Joe Brusuelas, Chief Economist at RSM, joining me here in studio.